Good afternoon. My name is Cynthia Rowley, Property Tax Director at the Department of Revenue. On behalf of the Department of Revenue, welcome to our third webinar covering property tax legislation enacted in 2017. To those of you that participated in our earlier webinars in August and October, welcome back. And for those that are joining for the first time, we're glad you're here. To send us a question or technical issue using chat, click on the green chat icon on the top right of your screen. A chat window will appear on the lower right and you can send us a question. In the box with the label Send To, please select Jessie Glancy. We received feedback that a 30-second window is too short. For this webinar, we'll wait about a minute to see if there are questions. If you need more time, please type question coming for us and we will wait a little longer. We'll mute our line while we wait for questions, and we will answer as many questions as possible during the 5-minute window at the end of each topic. We will mute our line while we wait for questions also. And if we aren't able to answer your question during the session, it will be addressed in a written Q&A after the session, addressing all the questions about the topic that we can at this time. Again, please chat to let us know if you are having trouble hearing, and we will try to adjust. Once again, at the end of the webinar, you will be asked to take a brief survey. Please take a few moments to let us know your thoughts. Your feedback is important, and it is used to make the process work better for all of us. The 2017 tax bill contained about 125 provisions that relate to property tax. It was a culmination of proposals worked on in the last 3 years. And over the next hour and a half, we'll share information about several of the 2017 legislative provisions that are already effective or will be soon. Additional information will be shared about provisions that are effective later as the time approaches. Here at Revenue, we've assembled our colleagues who are knowledgeable about the topics presented today. The individuals and their titles are listed on this slide. John Van Nerden will be discussing changes to the wind energy production tax. Sarah Vanderwall will be discussing delinquency and forfeiture modifications. Darius Masudi will respond to pre-submitted questions we've collected about the school building bond credit. John Coxine will discuss leased seasonal-recreational land. And Emily Anderson will start us off next and will cover Class 1C, Homestead Resort and Manufactured Home Park class rate.
This is Emily Anderson, and I will start this presentation talking about the 1C classification. New law enacted extends the qualification for Class 1C Homestead Resort property, which formerly was referred to as Ma-and-Pa resorts. So now it was to include property abutting a state trail administered by the Department of Natural Resources. Prior to the change, the requirement was limited to property abutting public waters. It is important to know that and be aware of that this is the only change in the requirements, and the property must meet all other requirements under the 1C classification. These requirements can be found in Module 3 classification, starting on page 13 of the Property Tax Administrator's Manual. This provision is effective for the assessment year 2018, taxes payable in 2019. To meet this requirement, owners of property desiring the classification as 1C must submit a declaration to the assessor's office and provide guest registers or other records by January 15th of the assessment year. So what that means is January 15th, 2018. As a reminder, records must show which cabins or units were occupied for 250 days or less in the year preceding the assessment year. To find a list of the state-administered trails, go to the Department of Natural Resources website at dnr.state.mn.us and type in State Trails in the search box. Here you will find a link to take you to the map shown on the screen or an alphabetical list on the trails as well. Again, for more information and a refresher of what the requirements are, the language can be found in 273.11, and guidance on administration can be found in the updated Property Tax Administrator's Manual. Our question and answer session is coming up next, but if you do have any questions regarding Class 1C Homestead Resorts after this webinar, please email us at proptax.questions@state.mn.us. We did not have any questions submitted prior to the webinar. If you do have questions on this topic right now, please chat them in. It doesn't look like we have any questions at this time. We will move on to our next topic.
Hello, this is John Kloxime, and I'm going to talk a little bit about leased seasonal recreational land. As you all know, unless specifically stated in statute, when publicly owned property is leased, loaned, or otherwise used for private purposes, the individual using the property is subject to tax as if they were the owner of the property. Minnesota Statute 272.0213 is an example of one of these specific situations that creates an exemption from property tax for private individuals to use government property. Here, land leased from a governmental body is exempt as long as the use is non-commercial, seasonal, recreational, residential, or Class 1C commercial, seasonal, recreational, residential. This statute was modified in 2017 to include Class 1C uses. Additional modifications included removing the requirement that there must be county approval before the exemption is effective, and that the property must be owned since 2008 and used for the same purpose. With the law change, those counties that did not pass a resolution approving these exemptions, who have leases on state and local government land under the two uses, will now need to exempt the land value portion of that use. This exemption only applies to the qualified lands, not to any structures or improvements on leased land. Those improvements are still taxable to the lessee. This provision is effective for assessment year 2018, payable year 2019. For counties to do right now, counties should make a diligent search through their personal property accounts for these taxable uses on leased government land. If an account is found that is land only or land with improvements, the land value should be exempted for the 2018 assessment. For more information, you can go to Module 5 of the Property Tax Administrator's Manual. That is the exempt module. Or if you want to write in a question, it's proptaxquestions@state.mn.us. There were no questions submitted prior to the webinar. If you have questions on this topic, please chat them in now, again to Jesse Galancy. We will wait about 1 minute to see if there are questions. It doesn't seem like we have any more questions, so we'll move on.
This is Emily Anderson again, and I will be covering a new classification that was added for the 2018 assessment year. This is the classification 4C5 III Class 1 Manufactured Home Park. With the new classification added, there will now be 3 separate classes for manufactured home parks. The newly added 4C5 III class with a reduced rate of 1% is what I will be going over today. For your reference, I have also included a screenshot of the updated 2018 assessment class rate table. It shows how it will be broken down. So in short, as I mentioned, manufactured homes are broken down into 3 separate classes. They are 4C5I, Standard Manufactured Home Park with a class rate of 1.25%, 4C5II, Manufactured Home Park Cooperative under 273.124, which is 2 subclasses depending on the number of owner-occupied units, so either a class rate of 0.75% or 1%. And then the 4C5 III Class 1 Manufactured Home Park, which now includes an educational requirement as has a class rate of 1%. For a property to qualify for the Class 1 Manufactured Home Park class rate, there are some requirements that must be met. They are the following. The first requirement is that 12 hours of qualifying education courses must be completed by either the owner or on-site attendant every 3 years. We will go over what these qualified courses are in the next slide. It is also stated in law that the owner must maintain original copies of the course completion certificates and then provide those certificates within 30 days upon request of the county assessor. Some statutes you will want to be aware of are the following. Minnesota Statute 327C.01, which defines a class manufactured home park as a park complying with 327C.16. This is also the statute that clearly defines the approved continuing education training the owner or on-site attendant must complete. The reason we're talking about it today is because the park owners or on-site attendants may begin accumulating qualifying hours beginning in 2017, so you may be receiving questions on these education requirements, so we want to address them. We have had a few questions of what type of training or education qualifies and if the assessor can require them to take certain classes. Per statute, the classes must be approved by the Department of Labor and Industry or the Department of Commerce for continuing education in real estate or continuing ed for residential contractors and manufactured home installers. So very specific. The 12 hours that are required are broken down to specific courses in the following. 2 hours on fair housing and 1 hour on the Americans with Disabilities Act, both approved for real estate licensure or residential contract license. 4 hours on legal compliance related to any of the following, so landlord or tenant, licensing requirements, or home financing. 3 hours of general education, which again must be approved for real estate, residential contractors, or manufactured home installers. And then 2 of the HUD-specific manufactured home installer courses. To verify if these course completions meet one of the requirements above, you must verify that the courses are approved by the Department of Labor and Industry or the Department of Commerce when receiving their certificates. The effective date for this provision is for assessment year 2018, taxes payable in 2019. What counties will need to do is require those seeking the classification to fill out an application by December 15th, 2018 for taxes payable in 2019. The new application we are creating will be available in the beginning of 2018. Once applications are filed and you receive a list of the courses, you must verify that those courses meet the requirements of 327C.16 that we just talked about. This can be as simple as looking on the application to see if it is approved by the departments that I have mentioned. Something to note is that if a park qualified during, let's say, the 2019 assessment year because the on-site attendant took the required training and they made application, and they also received the classification in 2018, there is an example we would like to talk about. Let's say that attendant stopped working at the park that qualified for this example in November of 2019. As long as the park qualified during that assessment year, even though the on-site attendant no longer works for the park, according to statute, the park would receive the Class 1 manufactured home park class rate of 1% for the assessment year in 2019. They would only get the reduced rate for the current assessment year and must have another qualified individual for the next assessment year in order to receive the classification. The updated 2018 class rate table again can be found in the 2017 law summary and at the end of Module 3, the classification module of the Property Tax Administrator's Manual. We are in the process, as I said, of developing an application for you to use. The application deadline is not until December 15th of 2018. However, we will send the new application in the beginning of next year. We'll have our question and answer session on this topic up next, but if you have any additional questions you think of after this webinar regarding the new Class 1 manufactured home park classification in the future, please email those questions to the Information and Education section at proptax.questions@state.mn.us. Again, there were no questions submitted prior to the webinar, and if they were, we did cover them. So if you have additional questions on this topic, please chat them in now. Again, chat them to Jessie Glancy, and we will wait about 1 minute, and during that time, we will place you on mute. It does not look like we had any questions, so we will move on to the next topic. Thank you.
My name is Sarah Vanderwall, and I work in the Auditor-Treasurer section at the department, specializing in tax forfeited land. I'll be talking about some of the legislative changes that occurred in 2017 regarding tax forfeiture. There are approximately 15 amendments to Minnesota Statute 28201 in 2017, but the 5 topics being covered in this webinar today have seemed to spark the most interest in county staff involved in the tax forfeiture process and management of these lands. The topics I'll be covering today involve using a real estate broker or agent to sell tax forfeited lands, the use of online auctions for land sales, persons who are now prohibited by law to purchase or repurchase tax forfeited lands, applying to the DNR to be able to sell tax forfeited lands on or near water, and the change in the amount of time to repurchase non-homesteaded property due to non-payment of property taxes. Counties can utilize this option now. You don't have to do anything if you don't want to. This is simply a tool to market and sell properties. A couple of questions we've gotten are, does the DOR have best practice procedures? No, this is a new law. Counties will have the discretion to create their own best practices. Question 2, what exactly can a real estate agent do for county auditors? A real estate agent can sell the properties for the county auditor without going to auction. They can be sold any time after forfeiture. To clarify, these are properties that are approved by the county board. Counties can utilize this option now. You don't have to do anything if you don't want to. This is simply a tool to market and sell properties. A couple of questions we've gotten are, does the DOR have best practice procedures? No, this is a new law. Counties will have the discretion to create their own best practices. Question 2, what exactly can a real estate agent do for county auditors? A real estate agent can sell the properties for the county auditor without going to auction. They can be sold any time after forfeiture. To clarify, these are properties that are approved by the county board. There were no questions submitted prior to this webinar, so if you have questions on the topic, please chat them in now. There were no questions that came in, so we'll move on to the next topic. All Minnesota counties are allowed to hold their tax forfeited lands auction via online auction. The department does not provide guidance on finding a vendor, but if you're interested in information about vendors that provide this service, I will suggest contacting the McCatfo group on suggestions on how to start that process. The county is responsible for clear and accurate information regarding where and when the auction will take place. Information on the auction notice, such as the website address and the date and the time of the online auction, are required just the same as the live auction. The county auditor is required to post this information on its website no less than 10 days before the auction. This law came into effect August 1st of this year. There were no questions submitted prior to this webinar, so if you have questions on the topic, please chat them in now. There were no questions that came in, so we'll move on to the next topic. Prohibited purchasers. This new law makes it illegal for those who already have delinquent property taxes, revoked rental licenses, or buyers who have canceled on a previous contract to purchase tax forfeited properties. This section also clarifies that no one can purchase these properties on behalf of a prohibited buyer, as it did not previously. This law is in effect now. Counties should be checking their potential buyers for conditions that now prohibit them by law from purchasing these tax forfeited properties. There were no questions about this submitted prior to the webinar, so we'll take a minute to wait for questions to come in. There were no questions that came in, so we'll move to the next topic. Land on or adjacent to public waters. Selling tax forfeited lands located on 150 feet of lake or river shoreline used to require special legislation, but the new law states that counties will apply to the DNR for approval instead, eliminating having to wait for the legislative session. The law has already gone into effect. The application process is the same as in the past. The DNR has a packet of required information on their website that is filled out and mailed to the corresponding regional office. Some questions that we've had in the past were, has the application process changed within revenue or the DNR? The answer is no. The application process is the same. There is nothing changing with the applications within revenue or the required DNR packet.
What is the turnaround time for approval with the DNR? That varies. The turnaround time of each DNR regional office can vary. What about previously approved legislation for specific parcels? There's no changes. Parcels that have gone through special legislation already and granted approval can still be sold at any time. There is nothing else that needs to be done. If you have any questions on this topic, please chat them in now. We'll put you on mute for 1 minute and wait for questions. There were no questions that came in for that topic, so we'll move to the next. Repurchase requirements. This law change allows counties to shorten a non-homestead repurchase timeframe from 1 year to 6 months. Lengthy required wait times to sell tax forfeited lands can be problematic for all counties trying to maintain several properties. This applies to non-homestead at the time of forfeiture only, not homestead properties. This law change is in effect on January 1st of 2018. On or after that date, counties may shorten the repurchase time on these non-homesteaded properties from 1 year to 6 months, reducing the time the county is obligated to maintain the property. There were no questions on this topic submitted prior to the webinar. If you have questions, please send them in now. Resources on where to find more information about any of the changes we've discussed today can be found on our website in the 2017 Law Summary and in the Delinquency and Forfeiture Manual, more commonly called the Red Book. The Red Book is still currently being updated to reflect the recent law changes. You can send questions to the Auditor or Treasurer email address listed on the slide, or contact the State Deeds email also listed on the slide.
Hello, this is John Van Nerden. I'm the State Assessed Property Supervisor at the State Assessed Property section to talk to you about changes about energy production taxes. First is an update to the criteria for determining the total size of wind energy conversion systems. Before this change, connected wind towers that were constructed in different calendar years were not considered part of the same system, even if one was constructed on December 31st and another was constructed on January 1st. One of the criteria for combining the nameplate capacity of wind energy conversion systems for the purposes of the wind energy production tax was updated. Now, wind energy conversion systems constructed within the same 12-month period may be combined if the other combining criteria are met. This change mirrors the language for the solar energy production tax. Next are two changes related to the filing of the wind energy production return. One change is the due date for an owner of a wind energy conversion system to file the wind energy production report has been moved from February 1st to January 15th. This is the same due date as for the solar energy production report. Also, the Commissioner of Revenue could not previously grant an extension for this return. Going forward, the Commissioner of Revenue may, for good cause, grant an extension for filing the wind energy production report of up to 15 days. Last is an update regarding the possibility for an extension to file the solar energy production report. Like for the wind energy production report I just mentioned, the Commissioner of Revenue could not previously grant an extension for this return. Going forward, the Commissioner of Revenue may, for good cause, grant an extension for filing the solar energy production report of up to 15 days. These changes are effective for reports filed in 2018 and thereafter. We will still certify the tax due for each owner for the current year to the county auditor by February 28th of each year. Counties still need to verify that all qualifying wind and solar energy systems are reported and contact us if anything appears missing or incorrect. If you'd like to look further into these changes, you can review the Property Tax Law Summary. If you'd like to learn more about energy production taxes, please go to our website and look up energy production taxes. The statutes themselves are under 272.029 for wind and 272.0295 for solar. If you do have any questions about energy production taxes, please feel free to email them to us at sa.property@state.mn.us. We did not receive any questions about this topic prior to the webinar, but if you do have any questions on this topic, please chat them in now. We'll wait about 1 minute to see if there are questions. If you need more time than that, please type question coming to let us know that you're working out a message and we'll wait. We've set aside about 5 minutes to address all the questions we can, and we'll start with those that are most commonly asked. I will put you on mute while we wait for questions. Seeing no questions about energy production taxes, we'll go ahead and move on to the next topic. Thank you.
Hi everyone, this is Darius Masudi again, the supervisor of the Auditor Treasurer Services Unit. I will be discussing the school building bond credit, which is targeted towards agricultural and rural lands to offset some school taxes. We discussed this credit in our August webinar, but we received some requests that we revisit the topic. To ensure that our team can thoroughly research each request, we have limited this topic to pre-submitted questions. I have prepared a brief overview of our correspondence and some of the questions we have received recently. I've included the following overview for those that need a quick refresher on the credit. The credit is not based on Homestead. It applies to all 2A, 2B, and 2C land, regardless of Homestead status. The house, garage, and first acre of land must be removed from homesteaded 2A parcels. Because the credit is not based on Homestead, linking or fractional homestead considerations do not affect how it is calculated and applied. The credit equals 40% of the qualifying property's net tax capacity multiplied by the school debt tax rate. The county auditor computes a school debt tax rate for each school district. The Minnesota Department of Education has this information in its levy limitation and certification report. The report shows all certified levies and adjustments for each school district. Use the amounts on lines 5016 and 5017 to calculate the debt rate. These lines are on page 31 of the 2018 report. The credit applies to all school debt levies, whether or not they are voter approved. In school districts that cross county borders, the school clerk will certify the levied tax to the auditor of the county where the district's administrative offices are located. We received a request to provide more explanation regarding this credit prior to the truth and taxation process. In August, we posted updated T&T instructions to our website in response to comments we received regarding the initial instructions we posted in mid-July. We thank you for the feedback we received that helped to clarify these instructions. The instructions can be found on our website by typing the keyword 2018 TNT in the search box. The August clarification stated that next year the credit must be listed in the Step 2 box on the TNT notice. It was not mandatory for this year's taxes. We also received a question relating to how the credit should be apportioned in instances where the credit results in a surplus for debt funds. First, apportion this credit to the TIF district based on the TIF capture percentage rate. Then, allocate the remainder to the school debt funds. If the debt funds are reduced to zero, allocate the remaining credits proportionally to all qualifying NTC funds based on tax rates. For more information on this credit, please visit our website to review the 2017 law summary. Also, an administrative memo was sent out to individuals on the county auditor's and treasurer's general distribution list on July 11th that discusses how the credit should be calculated, how the school debt rate should be determined, interplays with TIF, and many other questions. If you do not have a copy of this memo, please contact our unit at proptax.admin@state.mn.us and we will send you a copy. We received an additional request titled Clarification of the Law Changes Regarding Taxability of Ag Land on School Bond Issues. We unfortunately did not fully understand this request. If neither this presentation nor the memo answer your question, please do not hesitate to contact us at proptax.admin@state.mn.us. Other questions may be sent to the AT unit and Bill Sparks, and we will get back to you. or if your question involves PRISM reporting, please contact the PRISM team. However, if your question pertains to school taxes, please contact the Minnesota Department of Education. Thank you.
Well, this wraps up the webinar for today. If you have questions about the provisions discussed today, please send them to us using the property tax contact information provided above or on the previous pages. In terms of what you can expect next, this webinar will be made available online for your future reference and for those who could not attend today. The questions you submitted during the webinar will be summarized, answered, and also posted to the web. Please continue to submit your questions on these or any other provisions using the contact information provided, and we will respond as soon as we can. You can also find more information about these provisions and others in the law summary. Use keyword search 2017 property tax law summary. At the end of the webinar, a very short survey will automatically open. Your response is important so we know what worked and what didn't with this format. Changes were made based on your feedback from the last 2 webinars, so please take the time to let us know what you think. There are 2 more webinars scheduled to discuss 2017 legislative changes. One on January 23rd from 11 to noon, and another one in the spring. We're currently planning to cover the topics you see on your screen. And if there's a topic that you don't see on the schedule, but you would find it useful for us to cover it, please contact Jamie Hopkins at the email address listed. The topics covered in each webinar may change slightly based on questions and feedback that we get. Again, thank you to all who participated, and please let us know how this worked for you by completing the survey. This concludes our webinar today.